Okay, hello everybody, and welcome to Investing with IBD, sponsored by Vantage Point. Today is January 6th, 2021. Happy New Year, everyone. I'm your host, Arusha Paris, and today we have Scott St. Clair returning back to the show. Scott is a senior product coach at MarketSmith. Thanks for being here, Scott.
All right. Thanks, Arusha. I've got the record for 2021, most appearances.
And I think you might have the overall record too.
I didn't want to mention that. I thought that might be the case too, but I was certain I had the 2021 record.
Yes, definitely. On today's podcast, we are going to talk about the current market. We're going to talk about post-analysis, and we will end the episode with a few current ideas. So let's get right into the current market. The market's in an uptrend. We have distribution days on the NASDAQ, 3 of them, 5 on the S&P. So they're starting to collect, starting to get a little bit heavy. We're kind of on the edge right here. Scott, what are your thoughts on this market right now?
Yeah, I think today will probably be a distribution day as well on the NASDAQ, which is very strange. You had a real bifurcation of the market, NASDAQ down over 1%, S&P up 0.75% roughly. You're getting a lot of rotation. There's some groups that are starting to show up with really strong price action. They don't have the characteristics, earnings, sales, et cetera, that we prefer.
Right.
So I think there's a lot of cross currents. You always want to be on your toes, but I think right now you really want to be on your toes. It could be like a possible sea change in where the money is flowing.
Yeah, well, we did IBD live this morning. We had David Ryan on, who was a 3-time U.S. investing champion. He's been on the podcast a number of times too.
Mm-hmm.
I think this is one of the stocks he brought up. He brought up a number of agriculture stocks.
Yeah, I bought one as soon as he mentioned it. I thought, wow, that looks really good.
Yeah. There's, I pulled up Mosaic right here, and I just remember Mosaic from 2007 when it went on a great run. But it's trending pretty well now, and commodity stocks can move quite fast, and of course fertilizer stocks can definitely move. And as you mentioned before, Scott, with the groups, these guys can definitely all move in a group and have a really strong group move. So they're 49 right now, and I'm just clicking on their chart. For those of you who are listening in the car, you could always go back when you're at your computer, go to investors.com/podcast, and you can see we're showing the screen. We're showing some charts here, and I just pulled up the industry group chart for the chemicals agriculture group, which has had a strong move. And the one thing I wanted to see, I'm going to the overview here. And Scott, I don't know if you ever realized this, but I only really re-noticed it recently again. But this industry group ranking, you have pretty nicely right here on the right-hand side. And so 3 months ago, this group was ranked 115. It's now 49. So there is some momentum coming into this group. On a relative strength level, 3 months ago is 43. It's now 75. So that's kind of what you're talking about, right, Scott? With the money is going into some non-traditional growth groups, which, that's part of the game. There's going to be rotation, and money's going to flow to other industries during different parts of the cycle.
Yeah, I mean the tech stocks, and it's a broad overview, but as a general group, done really, really well. Does that mean they have to stop doing well? No, but if you study history, everything in the stock market works in cycles. So you have to be aware that there can be cycles of underperformance as well. And one thing about the indexes, they do a really good job of masking the underperformance in certain areas. And so you can, if you're just staring at the indexes, you can be fooled a little bit thinking everything is okay, I should be invested. But the stocks that you're invested in, could be under distribution. So there's a couple of ways you have to, stay on top of it.
Yeah, it's a great point. I generally get a much better feel for the market with individual stocks, because that's when I'm putting my money in. That's what's going to tell me whether I'm right or wrong.
Yeah.
By if I'm making money or not.
For sure. And my favorite point about that is if you buy XYZ and you use our rules and you buy it at 100 and the market goes up every day, but XYZ goes down every day, you're going to stop yourself out regardless of what the market's doing,
Yeah.
right? If you're following our rules. So that's why staying on top of these stocks, you don't have to, it's not always going to be, the market's a big headwind or a tailwind for sure, but what your stocks are doing is what's going to move your account. That's what's most important.
Yeah, I just pulled up the S&P 500, and maybe the S&P 500 takes more of that leadership now if money goes more towards some of the more traditional companies and more industrial related companies too. So something to keep an eye on. That being said, if you keep watching stocks that are getting relative strength, are showing relative strength, and are breaking out, the market will slowly pull you into those directions if you choose to invest in those type of groups or not. Now, there are times where I may see some groups like a chemical group where I just may choose not to invest, or I may invest a lot smaller because I just don't understand those companies that as much, and so I don't have as much conviction. What about you, Scott?
Yeah, I think it's a great point. A lot of times people will say, well, you talked about XYZ, it didn't have earnings or didn't have big sales or it doesn't always check every, quote unquote canceling box. And my first thought is, okay, great, it's your money, you don't have to buy it, right? And so that's one of the huge advantages, probably the most obvious advantage we have over the institutions is the ability to pass on a name. And if you don't like, if the market keeps going in that wave of these types of names and you slowly start to get out of the stocks you prefer, the types of names, say tech stocks, for example, you're just going to gradually go from 100, 80, 70, 50, 40% invested. And you can do that in your own account. You don't have to worry about, your mandate as a mutual fund manager.
Yeah, and so I know personally I'm definitely not anywhere near 100% in the market right now. Well, let me ask you this, Scott. How do you generally handle the beginning of new years? Are you just going to treat each one a little bit differently, or every year you're just a little bit slower to move in and you want to just see if it gets a footing?
Yes, the latter. I
Okay.
always start the year at zero. That doesn't mean I have to be all cash, but a lot of times I am. I just like to just start at zero. Um, I was listening to Stan Druckenmiller because I thought you'd want a quote, and I kept looking for a quote from him. There's a quote that he has, and I wanted to get the quote right, and I couldn't find where I heard it. Anyways, but he said something that I thought, well, this is great. He says, at the end of the year, psychologically and financially, you reset to zero, especially in his business, because he'd
Yeah.
get paid on, percentage of gains at the end of the year. He goes, last year's profits are yesterday's news. I love that. They are for me. I like to start at zero and I like to go a little slower and build up a cushion if I can, and then try to be a pig with the market's money versus, pedal the metal. I had a great year last year. Let's just go ahead and go pedal the metal this year. And if you catch a bad swing in the market, you can, be down 10, 20% pretty quickly. And then psychologically, it's tough to dig out of that hole and play the year correctly. So yeah, I always start at zero, like psychologically and financially, and try to build a cushion and then get more aggressive if I can get a cushion.
Yeah, and that just brings up a great point. And a lot of listeners I know out there, they probably had great years. And so first, congrats. This was a very unusual year, and to take advantage of it is well done on that, because it was not an easy environment, as we all know. But that being said, what Scott said, you have to treat this year a little bit differently. It's human nature, right? You have such a great year and you make a ton of money, and you start thinking you're good at this, right? And what happens? You get a little bit more complacent, and you start getting a little bit more relaxed with the rules in your discipline, and then you walk into a new year still, saying, I made a ton of money, like you said, and then the next year you get caught. Maybe you even make, like, for instance, I'll put up the little spotlight here, but for instance, we started out last year pretty well. I remember that. I was doing pretty well at the very beginning, and then it was just amazing at how quickly the market took it back. And you had to really be, and last year was the scariest year because there's no time to really, think. You just had to react very fast and say something's off. Oh, let me get his sidelines and react and analyze then, right? So you don't want to you want to be careful of that complacency, because every year is a new year, and don't give back that hard-earned money. That was a great year, and if you did well, you want to make sure you keep most of that money so you can let it compound in the right environments.
Yeah, yeah, and the math is cruel. If you 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 make 50% one year, and then you go down, 30% the next, or whatever the number is, you're basically back at even. It doesn't
Yeah,
seem fair.
yeah, yeah. And then of course you have to think about the taxes that
Taxes, yeah. I heard a
the
lot of
taxes will put you
horror.
down pretty quickly
I
back.
can tell you, the first year I ever started trading, in 1995, I didn't really think about taxes. I just like, I made a lot of money for a 25-year-old kid. And coming into January, I didn't send the government any money. And so then coming into January, I was just pedal to the metal, because that's what I'd been all
Yes.
year long in 1995. In 96, I got hit 20% in January, right off the top, super quick. And then come, March, I met with my accountant, and he gave me the tax bill, and I was like, whoa, I got to drain my account to pay the tax bill. And before I knew it, I was down 50%. So, at one point I'm here, and between the 20% drawdown and taking money out to pay taxes, my account was in half. And that
Wow.
was pretty tough for me to stomach. I just thought, oh my gosh, this is really hard to stomach. And I remember having a line in the sand on my account where I was going to close my account and just say, you know what, it's just got lucky. Made a bunch of money in a bull market, and I just got lucky. And I don't know if I would have closed the account forever. I don't believe I'd have done that. I don't even know if I'd have sent the money out. But I remember thinking, if it drops below X amount, I'm gonna send the money out, because I have just given back way too much. It was very devastating psychologically, and that's, in taxable accounts, you have to consider that. In IRAs and stuff, we've talked about a million times. I love the Roth IRA.
Yeah.
You get that after that no tax compounding, which is huge. But in a normal margin account, yeah, you got to consider the taxes too.
Yeah, and I mean, I know personally for me, every time I do pretty well in the market, I'm definitely putting a bunch of money to the side
Smart.
because I'm terrified of letting that money work in the new year and getting that 20% hit, and also now have to take more money out of the account. So I get a lot more conservative usually at the beginning of the year. And I also, me personally, and this is just my biases, and this has definitely been not the case the last couple of years, I think. But Januaries have generally been a little bit harder for me, and Februarys were always kind of really tough for me. Uh, but yeah, I've been proven wrong, and in the end, I've just done it long enough to not to try to not let those biases interfere too much. And I'm still saying, okay, what is the market saying though? I feel my emotions. I'm a little bit more hesitant, but what is the market saying? And last year was a perfect year, a perfect example of that. Scott, let's just talk a little bit of just a larger picture of last year, because there's so many lessons and for last year, but just some quick thoughts on some of the larger lessons to learn from 2020.
Yeah, I can't wait for 5 years or maybe less when the history books write about, the this year. I love to read economic and financial history, and last year is just one of the, in our lifetimes for sure, just one of the crazy, crazy years. It proves my adage, and I didn't make the adage up, but nobody knows anything. Nobody
Hmm.
knows. Uh, if you had known, what was going to happen economically before the year had started, you'd have done very, very poorly, barring maybe you made some money being short in the beginning. But you'd have just got run over on the rally back up, with a sheet of paper that gave you all the bad news that would be occurring. So it
Right.
just goes to show you don't have to predict. you just watch what the, like Bill would say, just watch what the market's doing, in in the last couple of weeks and what it's doing currently. And it's hard for people to grasp that that's really all you need to know to do really, really well in the market, because you have the flexibility to change if you're not trying to pretend that you know. And a lot of really smart people in this business have kind of lost their way through the years. I've seen them kind of come and go because they say, well, the market's going to do this. And then if the market doesn't do that, they're kind of stuck.
Yeah.
Especially if you go on, if you go on TV or whatever. And one thing, and even I kind of feel the angst, the anxiety of when we come on these podcasts of mentioning stocks or or anything like that, because I'm afraid, I don't want to put myself in that position where, well, I can't get out of XYZ. I just went on the podcast yesterday or 3 days ago and told everybody, that I liked it, that I was in it, and so it can be very hard when you put yourself out there and mention that stuff. So you have to remain flexible. All the times when people ask the portfolio managers, if they had to name, one or one word to describe Bill's, trading style, was always flexible. He didn't care what he thought yesterday or a week ago, or whether he was bearish 2 days ago. Justin tells an awesome story about, when he first got started, and Bill had changed his mind, and he was confused at how quickly Bill had changed his mind,
Right.
because he was just bearish a few days ago, and then Justin gets the sheet and there's a bunch of stocks on there. Well, why weren't you just bearish? So that's the key. I mean, if you have to, put it all into one word, it's flexible. You just want to bend with the breeze and just go with the flow of the market, and try not to get too married to either side, bullish, bearish, whatever it might be.
Yeah, I agree with the word flexible. I think the other thing, because you need to have rules, right, to enable that flexibility, to really be kind of an objective kind of participant, letting hey, in the past, letting history really dictate, this is trouble, this is acting well. I think the one danger though with the rules part is people have a tendency to write too many rules and be so specific about those rules, and you can very easily get caught flat-footed, because the market's every rally is going to be slightly different. Every
Yeah.
correction is going to be slightly different. And so I think the beauty of what Bill O'Neill and his rules is they are rules that work, but they are open enough and flexible enough that it adapts to any environment. And last year was perfect. The distribution days, watching leading stocks give big sell signals, it really got anyone who's following our system out of the market at the end of February, or you were
Yeah.
moving to cash heavily out in February, and it got you back in pretty early April, or end of April.
The
Yeah,
system last year nailed it. And
yeah,
there are years where it can be, there's a lot of false positives or false negatives, and you just got to live with that. It's like everything. But last year, the system just nailed it. It got you out within 3 or 4 days of the top,
yeah.
and got you back in within, maybe 6 days from the bottom. And the thing that was so strong with it is it gets you in when you don't want to get in.
And trust me, I did not want to get
Nobody
in.
did.
Oh my God, I
Yeah,
was terrified.
yeah,
And yeah, it does remind me of another point, because I manage most of my money using the system that we talk about here all the time, and on in all of our IBD content too. But I do have some money in other accounts, just in mutual funds, just to reduce the pressure that it has to be all dependent on me. And it was really right, I think, at March 23rd, or right at the lows, where I just started thinking about those accounts, and all I wanted to do was go into those accounts and sell everything right at the lows. And it's amazing at how your emotions will work against you and get you right. It causes you to make the wrong decisions at the wrong time. And so that's why you want to follow some of these rules to avoid being near the bottom and, having a panic attack. And I spoke to actually others who have been doing this for a long time too, and they said the same thing. They were calling like their other advisors and stuff saying, sell me out of everything. And then they caught themselves like, okay, never mind. Just
really?
mind. Like, yeah, I'm going to give another. Never mind. I'll give it another week, and then the market took off again. So the market is in an uptrend right now. Growth stocks continue to hang in there, but remember, there is a little bit more volatility in the market. There's distribution days, so keep an open mind. Let the leading stocks tell you what to do. Let the markets tell you what to do. We'll take a quick break, but when we return, we are going to talk about post analysis and the importance of it and what to do, because this is how we all get better. It's not fun, but it is a necessary exercise that you need to do every year. We'll be back. Want to dominate the stock market in 2021? With the COVID vaccines, the shifting political landscape, and a new year, it's virtually impossible to guess what will happen next. But with Vantage Point, you don't have to. Visit www.freestockcoaching.com and find out how Vantage Point's AI technology can forecast stock market trends up to 3 days in advance with incredible accuracy. Vantage Point's patented technology analyzes huge quantities of global data in seconds. Stop guessing. Check out www.freestockcoaching.com and experience Vantage Point for free. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Scott St. Clair is our guest on Investing with IBD, sponsored by Vantage Point. Okay, Scott, let's get into post analysis. Now, this is a necessary exercise, but personally, even after doing it for plenty of years, I do not look forward to doing it. So yeah, talk about it, and we'll go into a little bit more of the details too.
Yeah, I have to admit that I never did post analysis before I came to IBD.
Okay.
I just didn't want to do it. It's a lot of work, and it'll humble you a little bit. You have to be willing to put yourself out there, and even to your own self, to expose you'll have some strengths. We all have things we do really well in the market, and we all have things we do poorly. From Bill O'Neill down to me. And so you really want, and the main thing is about a post analysis is to find those, to be honest with yourself, to show you your strengths and weaknesses, so you can either build up your weaknesses ideally, or sometimes when I've found weaknesses, I've just decided, well, I'm weak at that. I'm just going to stop doing that for like options or futures. Right. If I try to trade futures and lose money, eventually it's like either get better at that or stop doing that. And so I just said it's easier just to stop doing it. And so that's what a post analysis can do, to help you to learn, like I said, where you're strong and where you're weak, and ideally carry that forward to the next year.
Yeah, and it does take time, even if you've learned some of those mistakes, to slowly improve. It may take years. It's definitely taken me years to unlearn some of the bad habits I was developing. But what you want to do, and this is kind of the minimum that you want to do for post analysis, you want to gather your trades, sort all the results by performance, and identify your best 3 trades and your worst 3 trades, and then go through them. Identify where you bought the stocks, where you added to them, where you got shaken out of them, all that stuff. You want to kind of mark it down, print out those MarketSmith charts, mark them up, and you want to figure out what you did right on those trades, what you did wrong on those trades. And a lot of times, sometimes even though you made money, you could have made it might have been a wrong trade. So you want to kind of identify. Yeah. So let's first talk about that, because we assume everyone knows about that, but talk about that part.
I've done my post analysis, and I like the idea of 3 trades. It's like going to the gym. If you've never done a post analysis, or you've never been to the gym and you want to start lifting weights, you wouldn't go to the gym and put 500 pounds on the bench press or the rack and start squatting it. You'd start with something easy. So if you've never done a post analysis, I love the idea of 3 trades. What I will do is I have some software that takes all my trades, and I'm a very active trader. So I need a software to do that. And so then I can sort by biggest gains and biggest losses. And then I just kind of go through and look for the ones where they're out, is that an outsized gain, relative to the account size? Is that an outsized loss relative to what I should be losing? And then just scratch all the stuff in the middle, see that way it's doable. And sometimes that might be 10 or 12 trades on both sides. But I like the idea of at least 3, right?
Yeah. And that's why I said because
Yeah.
that's what IBD has always said to do that. That's what those who've been doing this for a longer time than we were both doing it. That's what when we both started here in house, that's what they told us to do too. And it's because it's reasonable at that time, right? If you say go through all your trades, I make a lot of trades too. It's like there's no way I'm going to be able to go through every single trade. But most trades, as you said, most trades are going to be very quick losses, very quick gains. But you want to definitely first knock out those outliers, those big gains, those really big losses. Now, I think for those who are newer, and this is something that and this is probably the hardest part, and these are the most dangerous ones you have to knock out first. The cutting your losses. You want to definitely identify some of those losses that were more than 8%, and see how far down they went, and see where you could have gotten out of them.
Yeah, there's an old adage: every large loss started out as a small loss, and I would say that 99.9% of the time that's true. In my career, 25 years of trading, I've had some gap downs, but almost every outsized loss that I've taken, I could have taken it for a smaller loss. I just didn't want to. I was pigheaded, I was hoping it would come back or whatever.
Yep.
So you're right. And the other ones in the middle, if you get good at the really good ones you've done well in, and then the ones where you lost too much, you'll find that's why that adage exists, because you can go and look on a chart and say, oh, I got out there. Well, I had 3 or 4 days before where I could have got out at better prices and didn't. And I've lived that. But the ones I like to also, if you want to take it another step, is some big winners that you've traded but didn't make big money in. So
yep.
Tesla would be a perfect example for me. I might be the only guy in America that lost money on Tesla. So I bought it on April 27th, and it ran up. I thought I envisioned it as like a little cup with handle.
Mm-hmm.
And on May 1st, a handful of days later, I was down 5% and closed out the position. And it looks like nothing on the chart, but 173 down to 152 is enough to get me stopped. So I bought it there, that day exactly.
Wait, you bought it in April?
No, I bought it like 3 days before.
Yeah.
That, to me, that's a really good cup with handle right there.
Yeah, I think I bought it there too.
A lot of us probably did.
Yeah.
Very few of us got stopped out. And if you did, that's fine. I have no problem with the stop out. I have no problem with that trade. That was a perfect trade, in my opinion. But one of my rules is it's okay to get back in. Always, always, I can buy it back. And I don't know why. I just can't tell you why, but I just didn't buy it back. And so that was one of the rules that I have, is you can buy it back, and I violated that rule on Tesla and missed a really big win. Now, admittedly, I wouldn't have ridden it, split adjusted from 170 buying it back to 700. I mean, I just never would have been there for that whole move. But I might have captured 100 points or something, So yeah, you can see it on the chart there. That's a big swing down.
It was, yeah.
From 8 something down to 700. I can't survive that.
No, and I bought it around the same place where you bought it, and I probably added right at that high of that reversal day too, because I have a tendency to do that. And I got shaken out at the same place too. And you know what? I had no regrets selling there.
Yeah.
Because I was down more than 5% on my trades.
The right
or whatever,
way to play it, for sure.
Yeah. But one thing that I eventually got back when it started tightening up around 800, because I knew that, okay, this thing is going to leave me if I'm not in it. It's like the only way it's not going to go up is if I'm in it.
Yeah.
And so I don't want anyone else to get
The
go
mental health buy, like David
exactly,
Ryan would say.
exactly. So yeah, so that's where I got into it. But this is a perfect example because there have been hundreds of stocks, I think, where I've gotten shaken out of them, and because it's a shakeout in hindsight. But you do the right thing. But really, the next step is so you can take a step back first. The reason why we sell at that point is something's off. We're trying to keep our losses small, and also really the larger expectation is it's not acting right. And now my expectation is the stock should go down. If the stock doesn't go down, that's really breaking that expectation. And that's a really kind of subtle kind of thing that took me years to truly understand after doing post analysis and realizing, oh my God, I missed out on all these great stocks because I got shaken out of some kind of few day kind of really scary move. So getting back in, figuring a way to get back in is that next rule you need to write yourself. And I think, even though we mentioned this a number of times and throughout webinars over the years and all this kind of stuff, I think everyone kind of has to just go and do that post analysis and really see some real trades where they really messed it up. And you have those scars there to remind you that, hey, I need to change this. Or if you don't change and write some of those rules, nothing's going to change in your portfolio because this is going to happen every year.
Yeah. Yep. You're not going to know that why should I have a rule buy it back? Well, if you go through your trades and see enough times where you picked the right stock, but maybe the timing just wasn't correct, or maybe you misinterpreted the chart. It could be that that really didn't have enough time on the handle. It just needed another shakeout, right? And it
Right.
worked. It shook out and got me out. But I've never had a problem buying them back. Very rarely. Sometimes I feel like I go to the well too many times.
Yeah.
I just think it's gonna go. One thing our system identifies all the best stocks. It's just a matter of it's gonna go. I know it's gonna go, and I'll go back to it 2 or 3 times. And sometimes that fourth time, it's like maybe I'm misinterpreting this. But it only would have taken 2 times on Tesla to get it right. And so when you're wrong, you lose 5%, and you're right, Tesla's an outlier, of course. But let's just say I take profits at 20%. It's a pretty good risk reward ratio, 4-to-1 in my favor. When I'm wrong, I lose 5%. When I'm right, I make 20. I'll own the world in about 18 months if that was the case.
Yeah. So it's now another, and I think this is for a lot of people with post analysis, why they hesitate doing this, and you kind of see it with us talking is you're going to be wrong a lot more than you're right. I mean, it's not. I mean, you still could have had a good year. You're going to be so wrong most of the time and do so many dumb things that you need to get used to it, because that's human nature in many ways, and that's emotions getting the best of you. Even if you've been doing this for years and years, those emotions don't go away really. You just get a little bit better at managing them, but you need to get comfortable with making mistakes and knowing that you're going to be wrong most of the time in this game.
Yeah, the quote I was trying to find that Stanley Druckenmiller had said, and I'm paraphrasing, is he'd said, I sometimes I wonder how I even made money. I've made so many mistakes. And I think that too. I think, how did I make money this year? And sometimes like, wow, how did I do that well? I didn't have Tesla. I sold Lavago too soon. I sold C Limited too soon, and just had a monster year. It's like, how is that possible? So that's also encouraging that you don't. It's like baseball. I love the analogy of baseball. Mike Trout. I live in Orange County. Mike Trout's, he, I don't know where he lives. Probably Newport Beach.
I thought not in the same neighborhood as you.
Probably not. Probably not. But he drives by my house on the way to the Big A, because he probably lives in Newport Coast. But this is a guy with a $500 million contract that's wrong 60% of the time, right? Because he bats about 300, and he gets on base another 100 basis points, so to speak, with walks and errors and stuff like that. So 60% of the time he goes to the plate and he walks back to the dugout wrong. And he's a Hall of Famer, one of the best baseball players ever. You could do that at 25, 27, 28% of the time and make $3 or $4 million a year as a baseball player.
Yeah.
So a batting average, a win rate, I think is very overrated in investing, because I could go into the market and buy Apple and make 14 cents and do that all day long, but I'm not going to make any money. So I can feel good about myself and get it right 8 out of 10 times. I'd rather get it right 2 out of 10 and make 14 points or 40 points, or, even more sometimes if you get it right.
Yeah, yeah, and that I think that is the most encouraging thing. You can continually be wrong, but if you get a few of them, especially the way our system works, the one thing that I'm very confident in is that this system will identify a lot of great companies with huge potential. Whether they work at that point or whether they, and a number of them will never work, but you're not gonna be 100% wrong.
No.
There are going to be a few of them that you're going to be in at the right time
Yeah.
that go up a tremendous amount. And it really is that managing part that's the lifetime kind of skill to develop. And and those are the ones that also hurt a lot, because you mentioned none of those stocks with C Limited and Tesla and stuff like that. I was in some of those, but I never I could have gotten a lot better.
Mm-hmm. And
You
that's what
know.
the post analysis is for, help you get better. So it's got pluses and minuses. It's discouraging. It's a little disheartening. You're going to see a lot of the mistakes you made. But then in the end, you can say, you know what? I don't have to be perfect to do well in the market. And so that's the encouraging part of a post analysis as well.
Yeah. Now, so one last question in this kind of segment right here. But now, you've had mentors over the years. Now, have you ever shared any of your trades with them, or just get some input from them to kind of look at it from another objective view?
I have, run money side by side, in a hedge fund where we had two co-managers.
Okay.
So there was two of us, and and then we could see each other's trades, so to speak.
Yeah.
No, I've never done that with my own my PA. I
But
think,
even in that, you still had another set of eyes watching you.
yeah,
Well,
yeah, and
talk about that part at least, because
it's both good and bad. Running your own money, it's like everything. I think everything in life has a yin and a yang. I sometimes think if Bill would look in my account, he'd think I was bananas, because I might buy something, change my mind, and then a day later buy it back, and I like that flexibility of
yeah.
not having to explain myself, why, what happened. That's one of the advantages of running your own money. But yeah, having somebody to do that with it cannot hurt you for sure. I've had lots of, quasi mentors, I guess. David Ryan, for sure. I, followed him and went to plenty of seminars where he was at,
Hmm.
and, listened to him on CDs and with Bill, of course. And I have a lot of the IBD, seminars on CD that I can listen to. When Steve was doing them, and Mike and all these guys, and even the
Right.
ones that we went to, right?
Right.
So it's not quite the same, but it's out there. But I don't know. In the end, I think you have to kind of. It's like paper trading. I don't think it has that much. You have to kind of learn this on your own.
I agree with that for sure. And there's a balance with having someone else review it and stuff like that. But for those who are out there listening, if you know someone who's done this and done it well, and they can guide you a little bit, you don't necessarily have to show all your trades and stuff, but you
Yeah,
show a couple of trades
maybe
here and there.
do a post analysis, and
Right.
then if you have somebody that can review, yeah, and I think Justin's done that with Bill a number
Yeah.
of years. Again, we're bringing up Justin. We should have him on.
He
But
doesn't want to come on.
yeah, oh, is that what it is? But
No,
he
no,
tells a
he's
great
so
story.
busy. Yeah.
He did a post analysis, and then he brought all his charts on a plane and sat next to Bill for a plane, and had Bill, cornered when he wouldn't even let him get peanuts or get up to go to the restroom. And Justin would go on there and tell him, I'm sorry, Bill would say, okay, yeah, this is where you could have done better or whatever. You get the idea. And
Yeah.
Jim Ropel talks a lot about with Bill,
With Bill, yeah.
helping him. So yeah, if you have somebody like that, oh man, take advantage of it for sure. And I have a friend of mine who's he's amazing in the market. And so I lean on him when I'm down. Last year, um, there was a stock that I was in, and I just was too nervous about the market and the volatility of the stock around the earnings report. And I sold it before the earnings, and it went up a ton on earnings. And I was just so frustrated because I like this name. I wanted to be in it, but gosh darn, earnings reports are so tough.
Yeah. Yeah.
And so I called him, and I was pretty down about it, and he's like, there's another bus, Scott. I promise you. There's so many on the street. There's a bus every 15 minutes, and in the stock market, there's a bus even every even more. There'll be another one. Forget about that one. And it was amazing. If I could plot that phone call with my equity curve, it was like a cannon. It was right before the next stock I bought was Snowflake,
Wow.
and I had just total conviction in it, and just go for
Yeah.
the jugular size. And
Yeah.
I know I would not have been able to do that without having talked to him about that. He kind of talked me off the cliff a little bit.
Yeah.
And so, yeah, it can really help if you have somebody like that.
Perfect. So pulse analysis is one of those keys to success that you have to do if you want to get better at this game. Unfortunately, it is one of the hardest things you're going to have to do too. So coming up next, we are going to talk about a few ideas. Stay tuned. Tired of reading about other people getting rich in the stock market? Today is your day. Vantage Point's artificial intelligence has predicted countless market reversals, helping traders weather any storm up to 3 days in advance. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns well ahead of the news to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Don't delay, save your seat now. We are back with Scott St. Clair on Investing with IBD, sponsored by Vantage Point. Okay, Scott, let's get into a few ideas here. And the first one is NTR Nutrien Limited. And this is one of the stocks that David Ryan pulled up on IBD Live this morning. And it was, I remember when he was starting to talk about these agriculture stocks, I just started thinking, oh gosh, there are going to be a lot of viewers wondering, why is he buying stocks with no earnings and sales? But you know what? This is trending well, and the industry group is doing well, and so he eventually explained it. Sometimes for some of these turnaround plays, you go more off the technicals. Scott, what do you like about this?
Yeah, I like that David mentioned it. So I was watching IVD Live. NTR has not been on my radar. And as soon as he mentioned it, I just pulled the first thing I do if somebody mentions a stock is I always pull up the chart.
Yeah.
And look at that weekly chart,
It's incredible.
So if that was Facebook or Netflix or Google, I mean, you'd be buying it with both hands, right?
Yeah.
So I just, I subscribe to the George Soros theory, invest first, investigate later. I just started buying. And it's just kind of a pilot or probing position, whatever you want to call it. And then I have a plan to get out if I'm wrong. But one thing David said that kind of resonated with me a little bit is he talked about, having all these high flying stocks. So if your whole portfolio is Okta and CrowdStrike and Twilio and Zoom, it can be really harrowing every day. Your account can just be moving a lot.
Yeah, you don't have to tell me. I think I had all those at the same time.
Yeah, it's not. And he said he's owned Target for a long time, and it's not. No, normally I don't do that. I'm in the I'm always looking for the fastest horse. So it's nice to have something that might be a little bit slower, and you don't have to watch so much. But what also appealed to me was I was there in 2005 when Potash and Mosaic, those stocks, CF. They went up a lot. They went up like internet stocks in the 1990s.
Yeah.
So, if there's a sea change in the industry or, fertilizer, suddenly is in high demand and there's a supply shortage, these stocks can go up a lot. So that the combination of, triggered that old memory of those stocks previously, and the chart looks really good. And I just love the asymmetry of everything we do. In other words, I'm going to risk 5%, and who knows if it goes up half as much as it went up last time. From '05, it went up what is that? Is that 30 to 200?
Yeah, it might be even more than that.
Wow.
Well, yeah, from '05. Well, yeah, it broke out at 36, 35 and went up to 200, which, and yeah, so that's what I was looking at while you were talking. And so in 2006, to the end of 2005, 2006, once the stock really got going, it had 15 months in a row up.
Yeah.
It was just consistent,
Wow.
consistent.
What if
So
you just said, I'll buy it and I won't sell it till it has a down month?
it's an incredible, yeah.
Sometimes, I haven't looked at Tesla like that, but I imagine you could really ride. It wouldn't happen that often, but
Right.
man, you would get an amazing run once in a great while.
Yeah, and this one, so we're looking at it on a monthly chart here. The one key, and the one I think the big takeaways, that this has done it before, so it's possible that it could do it again. We'll have to wait and see, because who knows. But when you have that character could return, like Scott spoke about, if the potash, did I say right? And I know Chris now.
I know I
I
think
forget
I've
now
always
what
called it potash, and I'm
was it.
just gonna
It was
keep.
potash. Right
I'm
now,
gonna keep calling it that. It's too late for me.
is it potash or it's potash,
I
right? I think
think it's
that's what Chris said.
potash. It is,
So
like I said, I'm not
Chris,
changing now. Tomato or tomato, right?
yeah, Chris Gessel, who's the chief content officer of IBD, and also one of the stars of IBD Live. His family worked in the potash business and works in the potash business. So he said that this is the right way to say it, and I'm hoping I listened well enough. But yeah, so that's the thing that really stuck out to me when I saw this weekly chart. This thing can move. I do remember back in 2007 how a number of those stocks moved so well too. So want to keep an eye on. Now this is definitely more an industry play, more a technical play, and so it's not our traditional type of stocks that we look for. But that being said, you can always just manage your risk, use the charts to let you know when to get out of them, especially the downside. So that's Nutrien Limited. Now the second stock that we were going to look at was Corsair, and let me pull that up. And so that ticker symbol is CRSR. And so there's a new company. It's a gaming company. Now, what I like about it, and I have shares of this, and I've had shares for a while, but I've heavily reduced it over the last month or so. But what I found interesting about this company is they make a lot of components within the gaming. So they make the headsets, and that was why it stuck out to me, because I remember being in Best Buy and I saw like they have a section, they have a shelf there with Corsair, all their headsets and their keyboards and all these really gaming oriented things. Not your normal kind of mouse; it's a gaming mouse. But what I really liked about it, they were very expensive.
Oh.
And so while I might not necessarily buy them, I might go and buy the stock, because I've learned over the years, something like a Coach. I remember when Coach went on a dramatic run, or a Lululemon selling $100 yoga pants. You might not buy the product, but there could be a market that's more than happy to spend a lot of money on it, and that could lead to huge revenue for those companies. So Corsair stuck out to me when I saw it, when it was a new stock. And so they make not only the headsets or accessories, but the other kind of thing, and where they really made their name, because it's not a new company, they've been around for a while. It's they make a lot of the components within the computers. So not the chips, but like the fans and things like that, to really make the computers run more efficiently, because they heat up a lot when you put really fast moving or powerful chips in there. So that's my really probably poor description of the company. But these guys are well positioned. Esports, everyone's been hearing about that. That trend is not going away anytime soon. It's just going to keep growing. And so these guys are well positioned to be part of this trend. They provide a lot of equipment to do little videos. A lot of people like to broadcast their gaming on YouTube and Twitch and all these things. And Scott, I know your son likes to watch a
Yeah.
bunch of this stuff, and we've seen it with my niece and nephew. They love watching YouTube and watching all these videos, and so a lot of people like to broadcast their gaming on there, and so Corsair will provide a lot of that equipment too.
Yeah, and I didn't own it for the move from 25 to 50, unfortunately, out of that kind of IPO base. I think it's IPO base. I remember
Yeah, it was.
it
Yep.
was one of the stocks you mentioned on
Yeah,
IBD Live.
yeah,
But when it pulled back to the 10-week line or the 50-day, if you're on the daily chart, it's what Charles would sometimes say, and I don't know if he's looking at this stock or not, but I love how he says the first pullback to the 50-day is a layup. In other words, you get a stock that's made a really good move, a strong move, you get that first pullback to the 50-day, you want to take advantage of that. So that kind of stuck with me when I saw this stock pull back to the 50-day yesterday. So I was buying today. The other thing that I really, really loved, well, besides the big earnings and sales, the numbers are really good.
yes.
But
That's what really stuck out with me initially.
yeah, that's how it's going to come up on your radar. Besides
Hmm.
relative strength, it has a lot of the characteristics. But if you look on the right hand side, I don't know if people can see within the based on where our window is of us, but you've got the IBD mutual fund ownership. Is that visible?
Yeah, that hopefully will be visible. But
Good, good.
the quick answer is Fidelity Contra Fund has a
Bingo.
small position in it.
Yeah, and it's a small position. For Fidelity Contra is my favorite. I always like to see him in there. But
Everyone's favorite.
what
Yeah.
really sticks out to me this is a small company, Corsair, and he just, as a general rule, because I follow almost all his buys and positions, companies this small, he doesn't usually normally uh, uh, get involved in because he can't, right? From a
Right.
liquidity
Well,
standpoint.
there's like $100 million dollar volume,
Yeah,
right?
but I'm talking about the overall size of the company. I mean, he'd
Oh,
practically have to buy the whole company to move the needle on his fund.
it's true.
There's only 15 million shares in
There's
the
only
float,
15 inch. Yeah, you're
but
right.
yet he's still in there, right?
Yeah,
And
yeah.
so my thought process is he must think this could make a really big move and become larger, and then I can add more size in it as it becomes a larger company and more liquid, et cetera. So yeah, that really stuck out to me to see Contra have a position in a company this size. In my experience, I look at this very regularly. Anytime I see something, and he just doesn't own stocks, that are not, multi-billion-dollar stocks because it's hard. If
Yep.
Corsair, triples from here, it's not going to move the needle on his fund at 0.01%. He needs to build a larger position to move the needle.
No, it's a really great point. I like you. I've been adding the last couple of days back to the Corsair position because it just came back to the 50-day. Now, I wasn't thrilled to buy it at that point, but I know the first time touching that 50-day, and so just start slowly buying. And I just those numbers are huge, and the fact that Contra Fund's in there too. It's like take a shot. If it sells off, if I'm down 5% or whatever, I'll get out, right? And so
Exactly.
that's the chances, and that's the risk that you have to take sometimes. But so we'll have to wait and see. The market will tell us whether we're right or wrong on this. But that's Corsair Gaming, ticker symbol CRSR, and then the final stock is Uber, the ticker symbol Uber, UBER. And I just pulled it up on a weekly chart here. And Scott, what do you like about these guys?
So it's one thing you said about Corsair is exactly what stuck out to me on Uber. I don't have a car. I got in a car accident, and then we were
Oh,
in the middle of,
and you haven't got a new car
still
yet.
haven't gotten one.
Wow.
I don't really need one
Yeah.
until I have to start driving more. So I just Uber everywhere. And what you said this morning on IB Live, it's a verb, right? You Google.
Yes.
I don't internet search anything. I Google search it.
Yeah.
So if my wife needs her car, I always say it's all good. I'll just Uber there. So I had to Uber to the beach this weekend, and
You poor
I
person.
pulled up Uber in the morning. What's that?
I said, you poor guy. You had to
It's
Uber to the
tough.
beach.
Yeah, it's tough living so close to the beach. And I pulled up Uber in the morning and it was $100. Now the beach is about 20, 25 minutes away from me. It was $100.
Wow.
And so I said, well, I guess I'm not going because I'm too cheap to pay 100. And Lyft was $25. So I just used Lyft. Now I was listening to a podcast, a guy who's a value investor. It's funny how the moons all came together for this. And he was talking about Uber and he gave a very compelling story about owning Uber as a value investor. And I thought that was very
Wow.
strange. Yeah. And then, so what do I do, right? Anytime I hear somebody mention a stock, I pull up the charts right on the 10-week line,
Yeah.
so it just kind of combined. Now, the Corsair thing you mentioned about the headsets being too expensive, you wouldn't buy them. It's the same thing I felt about Uber. I would never pay
It's funny.
$100,
That's really,
but somebody is doing that.
yeah.
Uber, those guys are not dummies. They know what Lyft is charging at the same time, right? They didn't adjust their price even a little bit, So at $100, a lot of people prefer that comfort of Uber, of just the brand name of Uber.
Yeah.
And so they're able to charge 100, whereas Lyft is able to charge 25. And like you mentioned with Corsair, I'm not going to take Uber, but I want to own the stock. I want to own the best brand. Now, I'm not going to own Lyft. I don't need to own both. I think you either get them both right or both wrong, probably. But I think Uber's the better brand. And that pricing just kind of stuck with me when I saw that. Is that they must be doing something right that they're able to charge so much more. Now, this maybe is a unique situation. Most of the time, the prices are very, very close,
Right. Right.
but this was a way out of whack, and so that stuck with me. So long story short, I own the stock. Bought it off the 10-week line, just like Corsair, and just like you've said, I'll manage my risk. If I'm wrong, I'll lose 5%. And it's not going to be like Corsair. If you get Corsair right, you could make a lot. Whereas Uber, to make a lot, you'll probably have to be very patient over a long time, which is fine. A lot of people are more patient than me, but it doesn't mean I can't, maybe capture 20, 25% in it over a number of, weeks to months.
Yeah. Well, I own shares of Uber too. One of the big reasons, and this has always just kind of been on that radar, just simply, it's kind of like it reminds me of Facebook years ago. It's one of those big brand names that everyone uses. And if all of a sudden you start seeing the confirmation on the technicals, you want to be there, because if they truly prove that they can monetize and now their business is going to be good, a lot of funds are going to just a lot of growth funds are going to start moving into it. So I noticed it and it broke out. You was crazy. I would have bought it on November 4th, because it broke out very powerfully, had a breakaway gap on earnings on November 4th. And a lot of times that is a buy point for me. The reason I didn't buy it was because we had the elections going on, and in California, there was a proposition about how to treat Uber drivers,
Yeah.
employees or contractors. And so I was a little nervous about that. And that was a mistake. I think I should have bought a little bit at least, and taken a shot, because it was acting well, and it kind of has a story, and it's now as a technical action. It doesn't have necessarily the numbers just yet, but I've seen it enough where you have these kind of really interesting companies that are potential huge disruptors, and obviously Uber's disrupted a lot of the taxi industry and a number of other things. Uh, you have that. You want to always give those stocks a chance at least to consider, right? You maybe don't buy it, but you want to look at it again and say, should I, and strongly consider, should I buy it? If you start getting the technical actions, you start getting your entry points of however you buy them. I do own shares of it. Let's see what happens. It would not surprise me. It kind of reminds me a little bit of Facebook when, so let's see what happens on it.
And not every stock in our database, the biggest winners, roughly 1 in 4, are stocks like Uber,
Right.
turnarounds, where
Right.
they didn't have earnings and sales. It's not that they don't have sales; they don't have growing sales, year over year.
Yeah.
But you don't want to necessarily, I don't think, completely rule them out. Now, if you had a portfolio of 10 stocks, I wouldn't want to own 10 potential turnarounds. I would probably own, 2. But that it's nothing wrong with having a couple of them in your portfolio because they can be big winners too.
Yeah, so I do have a little bit smaller position in an Uber, and obviously the huge difference between an Uber and Facebook at this point is Facebook really started getting those earnings once it started going. So you want to, so that's why I have it a little bit smaller. But it's just one of those kind of big names everyone recognizes. And I also, it's funny you mentioned that, Scott. I actually use Lyft too, and it's not always the same. I mean, they're always usually the same prices, but one time it was hard. I couldn't sign back into my Uber account, so I just tried Lyft, and I just stuck with Lyft. But just keep an eye on it. I think from the stock perspective, right now at least, Uber is definitely the leader of the versus a Lyft there. So there you go. That is Uber, ticker symbol UBER, and those are a few ideas that are worth considering. Now, remember, take a look at them. If they appeal to your strategy, try them. You can and if they go against you, always have that exit strategy to manage your risk. So thanks, Scott, for joining us today.
Oh, of course, bud. It's always fun.
Next week, we are hoping to have Chris Gessel on the show. He's going to try to make it work. If not, we will have someone else. But Chris is the Chief Content Officer of Investors Business Daily, and he hasn't been on for a while, but so it'd be great to have him on and get his thoughts on the market. So that's it for this week on Investing with IBD. I'm Arusha Pierce, and thanks for listening.
And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.